The IRS has a special rule called Section 1256, which provides a unique tax treatment for certain financial instruments. Under this rule, profits and losses from specific futures and options contracts are split for tax purposes, offering a significant advantage to traders. Specifically, 60% of the gains are taxed as long term capital gains, and the remaining 40% is taxed as short term capital gains. This split applies regardless of how long you actually held the trade, which is a key benefit for active traders. This means that even if you held a futures contract for just a few minutes, you still get the benefit of long term rates on the majority of your gain. This preferential treatment can lead to substantial tax savings, especially for high frequency traders. If your CPA doesn't catch this error, you'll end up paying more tax than you legally need to. To properly receive the benefit of the 60/40th split, these qualifying trades must be accurately reported on IRS Form 6781. They should not simply be lumped into Schedule D as short term gains, which would negate the tax advantages provided by Section 1256. So, what specific products qualify for this advantageous 60/40 rule? This includes futures contracts traded on US regulated exchanges such as the CME or ICE. Examples of these qualifying futures contracts include S&P 500 E-mini futures, commonly known as ES Nasdaq 100 futures or NQ, Dow Jones futures or YM, and gold futures or GC. Other qualifying futures include contracts on agricultural commodities, such as corn futures or ZC, and soybean futures or ZS. Energy futures like crude oil (CL) and natural gas (NG) also fall under this rule. Broad-based index options also qualify for this rule. These include S&P 500 index options, or SPX, NASDAQ 100 index options, or NDX, and Russell 2000 index options, or RUT. Volatility index options, such as VIX options, are also eligible for the 60/40 tax treatment, providing another avenue for tax-efficient trading. Additionally, currency futures traded on exchanges, such as Euro FX futures, or 6E, and Japanese yen futures, or 6J, are also included under the Section 1256 rule. What does not qualify for Section 1256 treatment? Contracts for difference, or CFDs, do not qualify because they are not regulated in the US and therefore receive no Section 1256 treatment. It's also important to note that options on futures contracts, while related, have their own specific tax rules and may not always fall under the same Section 1256 treatment as the underlying futures themselves. Also, ETF options like SPY or QQQ, or single stock options such as Apple or Tesla, do not qualify. These are considered equity options, not Section 1256 contracts, and are taxed differently. Here's the good news for many traders. You do not need to be classified as a day trader to qualify for these benefits. Furthermore, you do not need to make any special mark-to-market election. If you traded qualifying futures or index options even once, Section 1256 applies automatically to those trades. There's no complex application process or special status required. At the end of the year, all of these qualifying trades are treated as if they were closed, a process known as mark-to-market accounting. Your profit or loss is then taxed with the beneficial 60/40th split. So, where exactly do you find this information on your taxes? Many US brokers will provide a summary of your Section 1256 contracts directly on your Form 1099-B. However, this crucial information is sometimes buried deep within hundreds of transaction lines, making it incredibly easy for many taxpayers and even some tax professionals to miss it. To recap the key points, the 60/40 rule offers you highly favorable tax rates on profits from many futures and broad-based index options, regardless of your holding period. Don't let your broker's potentially confusing reporting lead to overpayment. Always ask your CPA to specifically check for Section 1256 trades and ensure they are filed correctly on Form 6781.